A credit score is one of the most important numbers in your financial life, yet many people do not understand how it is calculated or what it actually represents. You are told that you need a good score to rent an apartment, buy a car, or secure a mortgage, but the scoring system can feel like a mystery. Some believe that carrying a balance on their credit cards is necessary to build credit, while others think that checking their own score will lower it. These common misconceptions can lead to costly mistakes. In this video, we will explain credit scores in plain, simple English. We will break down the exact percentages that determine your score, expose the most common myths, and outline a practical step-by-step checklist that you can use to build and maintain a strong credit profile over time. To understand your credit score, you must first understand what it is measuring. A credit score is a three-digit number, typically ranging from 300 to 850, that represents your creditworthiness to lenders. It is a mathematical prediction of how likely you are to pay back borrowed money on time. This number is calculated using information from your credit reports, which are compiled by three major credit bureaus, Equifax, Experian, and TransUnion. The most widely used credit scoring model is the FICO score. Your FICO score is divided into 5 distinct components, each carrying a different weight. The largest component, accounting for 35% of your score, is your payment history. Lenders want to see that you pay your bills on time. A single payment that is 30 days or more late can cause a significant dip in your score. The second largest component, making up 30%, is your credit utilization ratio. This is the amount of credit you are currently using compared to your total available credit. For example, if you have a credit card with a limit of $1,000 and your balance is $300, your utilization ratio is 30%. Lenders prefer to see this ratio kept below 30%, and keeping it below 10% is ideal. These two categories alone determine 65% of your total credit score, meaning that paying your bills on time and keeping your credit card balances low are the two most powerful actions you can take to build a healthy score. The remaining 35% of your score is split among three smaller categories. The length of your credit history accounts for 15%. Lenders like to see a long track record of managing credit, which is calculated based on the average age of all your accounts. New credit accounts for 10%, which measures how many accounts you have opened recently. Opening multiple accounts in a short period indicates risk. Finally, your credit mix accounts for the last 10%. Lenders prefer to see a variety of credit types, such as credit cards and installment loans. By understanding these weights, you can focus your attention on the factors that influence your score the most. Many of the common beliefs surrounding credit scores are incorrect. One of the most widespread myths is that you must carry a balance on your credit card and pay interest to build your score. This is false. Lenders report your balance to the credit bureaus once a month, typically on your statement date. You can pay your statement balance in full every month to avoid paying interest, and the credit bureaus will still receive positive reports of your activity. Paying interest does not improve your score, it simply wastes your money. Another common misconception is that checking your own credit score will damage it. It is important to distinguish between hard inquiries and soft inquiries. A soft inquiry occurs when you check your own score through a monitoring app or when a lender pre-approves you for an offer. Soft inquiries have no impact on your score. A hard inquiry occurs when you formally apply for new credit, such as a credit card or a car loan, and give the lender permission to review your file. Hard inquiries can cause a temporary dip of a few points, but they are a normal part of applying for credit. To build a strong score without paying unnecessary fees, you should focus on simple, consistent habits. Use a single credit card for a small monthly recurring bill, such as a subscription service. Set that card to auto-pay the statement balance in full every month from your checking account. This simple setup guarantees a perfect payment history and a very low credit utilization ratio, building your credit automatically. Additionally, you must avoid closing old accounts unless they charge high annual fees. Because the length of your credit history accounts for 15% of your score, keeping your oldest accounts open, even if you do not use them frequently, helps maintain a higher average account age. If you close your oldest card, your average credit age will eventually shrink, which can lead to a dip in your score. Instead of closing the account, you can keep it active by charging a tiny purchase once every 6 months to prevent the lender from closing it due to inactivity. To monitor your progress and protect yourself from errors, you must review your credit reports regularly. Lenders can make mistakes, and identity theft can damage your score without your knowledge. You are entitled to a free copy of your credit report from each of the 3 major bureaus every year through the official government website, annualcreditreport.com. Reviewing these documents allows you to check for inaccurate accounts or incorrect payment statuses. Let us look at a simple diagnostic checklist to help you maintain your score. Frequency action item target metric, monthly pay statement balance in full, avoid interest charges, monthly monitor credit utilization, keep below 30% of your limit annually, download free credit reports, check for errors or fraud. If you find an error on your report, you can file a dispute online directly with the credit bureau. They are required by law to investigate the claim and remove inaccurate information. Building a strong credit score is not about playing games or paying interest. It is about demonstrating consistent, responsible financial habits over time. By focusing on timely payments and low utilization, you build a profile that makes you an attractive applicant to lenders when you are ready to make major life purchases. Furthermore, be cautious when using credit repair services. Many of these organizations charge high fees for actions you can take yourself for free, such as disputing errors or negotiating payment plans with creditors. Lenders cannot remove accurate negative records before the standard 7-year limit. The only true cure for a damaged credit history is time and a consistent record of on-time payments. By taking control of the process yourself, you save money and gain a deeper understanding of how the credit system operates. The Budget Mechanic helps everyday people fix the way money moves through their life. We explain budgeting systems, debt payoff methods, saving habits, credit basics, and financial decisions in simple, practical terms. This channel is for education only, no hype, no stock picks, no get-rich promises. This video is general personal finance education, not professional financial, investment, tax, or legal advice. Financial situations vary and details depend on individual circumstances.